Recording. Welcome, everyone. I want to introduce to you Beth Cummings of Kerr Cummings. I believe Wayne is on the line too as Esquire. But today we're going to talk mostly about unrelated business income tax and unrelated debt financed income because it's a subject many in the audience want to hear about. A lot of people are concerned about it and are worried about it. And I think Beth is going to make everybody feel pretty good about it, even if it happens, and don't worry about it. So, hey, Beth, would you just give a little bit of your background, your professional background, where you worked and how long you've been doing this? I know we've been working together for over a decade. And you handle a lot of our clients' forms and questions, etc. So, Beth, welcome, and please tell us a little bit about yourself.
Thanks, Carl. I appreciate the opportunity to chat with your customers and clients today, and I just hope I can clear up some of the confusion around this area. And I am a 1990 graduate from college and jumped right into public accounting. And I've been in the tax area my entire career. And about 10 or 11 years ago, I joined Wayne Kerr and really discovered more of a depth to my knowledge in the legal aspects because I was not currently working with a lawyer in my prior position, and therefore I was able to look at things in a whole new light, and I think we're able to bring a lot more to our clients now that I see it from both sides. And I really appreciate the knowledge that Wayne has passed on to me through that, and that way it allows me to help the clients, and there's no more of this back and forth between professionals where Wayne and I are on the same page, we can form entities, and then I can execute on the tax strategies that Wayne has employed.
Yeah, I love the one-stop shop that you guys offer there, but you just made me feel really old when you said you graduated in the 90s. I'm thinking back where I am. So yeah, not quite a youngster, but way younger than me.
Yeah, I'm not feeling too young anymore, Carl.
Yeah, well, it all depends from where you're sitting.
Relative, that's right, that's right. Yeah. As Wayne would say, he's earned the gray hair. I'm right there behind him, so.
Right, and you do 990Ts for just IRAs. You also understand the, you know, what an SDIRA LLC is. And I know you were on a previous webinar with Wayne that our audience can go and look at if they want to know more about the self-directed IRA. But tell me a little bit about what your thoughts are there.
I think some of my early slides in this presentation are with regards to a lot of what Wayne has probably covered in his prior webinar, but I think it'll bring our viewers in a quick way up to where we start to want to talk more in detail regarding unrelated business income tax and unrelated debt finance income, because that is an area of confusion. I know that a lot of folks think that because you're in an IRA investment vehicle, that there is no tax implication because you're in a tax deferred element. However, there are certain rules that apply and certain transactions that would indicate a use of particular tax forms, one of the more popular being a 990T, which is where we report unrelated business income tax or unrelated debt finance income. So there could in fact be some tax filing and even some tax due on those forms. But even if we were not utilizing a 990T, we would also, in some regards, need K1s filed, 1099s filed, and I think a lot of folks forget those things because they think they're safely tucked in an IRA.
All right. Hey, can you do me a favor and accept the presenter slides so we can see some of your slides now that you told me you're going to have some slides?
Yep, I sure will. I was going to take us right through to the beginning slide, which is really sort of Wayne's bailiwick, where he would begin the setup of an SDIRA LLC for someone. But if you would rather jump forward to the tax implications, we can quickly run through these and bring people up to snuff. how do you want to approach that?
Oh yeah, if you can, just tell us, what the most common investments are, and we'll go through this and
Sure. I know this was new to me. I know Wayne had been working in this field for years, and when I came on board about a decade ago, this was new to me, and I thought it was an exciting way for us to offer our clients different vehicles for investing, because the stock market is a wild ride, and although it's positive at this point, we like to diversify investments, and we have clients that want to have a little more flexibility. So this SDIRA is a great vehicle. As I always tell you, Carl, I could sell CamaPlan anytime, any day, because I feel like this offers so much flexibility to people, and we've been able to bring so many of our clients into the SDIRA world, and they're thrilled with the results they're getting. I know a lot of them are invested in real estate. I know Wayne and I, if I were to pick a specialty for us, it would probably be real estate investing, because even our entrepreneurs that have other lines of business that they're running usually end up either owning the real estate that they're running their business out of, or jump into a real estate venture outside of that. So a lot of our structuring does revolve around real estate. However, there are other vehicles to invest, such as tax liens and mortgages. We have non-performing notes, hard money lending, things like that. So it's been exciting for us to connect clients that want to invest and clients that have need.
Are you there?
Yep.
All right, cool. All right. Tell us a little bit about using the SDIRA LLC.
I know Wayne would prefer, and if he would like to jump in, he can feel free, to protect your investments inside an LLC. There's that, just as you would utilize outside of an IRA, there's that legal protection that the LLC affords you. And I believe we like that protection to surround your SDIRA as well. So I know Wayne would recommend the use.
Yeah, we like it, Beth, from a limitation of liability. For example, if you had $1 million IRA account and you decide to go with $100,000 into a real estate venture, instead of subjecting the entire million to exposure of the real estate venture, what we would do is take $100,000, invest it in the LLC, and have the LLC buy the real estate. So therefore, if something would go wrong with the real estate venture, then you contain it within the $100,000 and wouldn't subject the $900,000 to potential liability.
Mm-hmm.
Gotcha. Well, one of the other reasons that I hear people talk about it is they think they're going to get rid of the cost complications, but then if they set up a LLC in California, I heard that their renewal fee every year is like $800. So it could have cost implications, but I think the liability, I think the speed of it is where they really come into play. The speed of getting something done. If you're buying a tax lien that needs to be bought in the next 15 minutes or 2 hours, or a tax deed, something like that. So I think these are definitely good uses of the SDIRA.
I know also, Carl, I have a lot of clients that come to me and think that they don't have enough money to get in the game, so to speak, and the allowable pooling of capital between multiple investors is a biggie for me as the accountant, because I can at least offer people the ability to, maybe if they don't have hundreds of thousands of dollars sitting waiting to be invested, if you have 50 and I can pool you with 3 other people that have 50, now you can jump into the game and start perhaps with your first note or your first property and get a taste of it. And then as your assets grow, you can begin to take it over on your own. And the LLC allows you to have multiple investments like that.
Yeah, and I've even seen people pull, their IRAs, their HSAs, their kids ESAs and things like that into one pooling. So there's a lot of rationale for it, but all those have specific tax consequences, because some are tax-free accounts, some are going to be before tax, so they'll be taxed when you take them out. Some may be prohibited, etc. So You got any other considerations we should look at?
Yes, and I thought this might be a good time just to bring up something that's not on the slide, but the use of an EIN for your SDIRA LLC. I've had a lot of folks this year in particular who for some reason felt that they did not need one. And I have time and time again needed to acquire an EIN, a tax identification number for people's IRAs individually or their SDIRA LLCs. And that is most useful from the perspective of investing, let's say, in a partnership interest, or if you have interest income coming to you within your IRA from an outside note, a hard money lend, let's say, and the borrower needs to issue you a 1099 for interest. To what number are we issuing the 1099? And the last thing I want to do is tie someone's personal social security number in any way to this SDIRA transaction. I want to keep it as its own entity. So we encourage people to utilize the separate EINs.
And what about the didn't we run into another custodian that the client wanted to use the custodian's
Yes.
EIN?
Yes, the client was arguing with me on the phone about didn't want to pay to get an EIN number, which I understand it's another fee. But in the end, he was arguing with me so much so that we got a conference call going with himself, myself, and his custodian, not CamaPlan. And I presented the case to the custodian with him on the phone. He agreed with what I said. And in the end, the custodian said, absolutely, you may not use our EIN and you must get your own, and your accountant is right. And so I don't know where these people get the idea that they can move along and utilize the custodian's number or their social. That is not a good idea.
Yeah, we should almost have a separate webinar just on the EIN, but you are right. And I'll tell you where they got it. If it's just interest payments, we used to do that and used to give them the custodian number. But what happens then is if a note goes bad, then they have to do a 1099 bad debt number. And then that goes, where does it go against it? They don't get any credit if it goes against our tax ID if they need it.
And I've gotten several notices from IRS with regards to these types of LLCs, and they're saying, Jane Smith is involved in your LLC and she didn't get a K-1. Well, that's because I've got 50 LLCs out there utilizing the custodian EIN, and the IRS doesn't know what to do with that. And so therefore they're all commingled, and the client will say to me, this person's not part of my LLC, and I'm aware of that, but the IRS is not aware because we didn't all get our own numbers. So it can cause a lot of confusion.
Right. And the other thing that I caution people against is, again, regulations have changed, and the way a lot of these big cities like Philadelphia, Detroit, Houston, they're now requiring when you have a real piece of real estate that you get a real estate license or a business license or whatever it is. It's just another revenue generating income for the city. But the problem with that is if you're using our EIN and they're using our EIN, then when you go to a closing, they can attach, or they try to attach, that money from your account to one of our other clients' accounts that's using the same number and trying to pay that off. So that's the main reason that we started changing it. And it has a lot of other benefits with FDIC protection, et cetera. So, a one-time, $100 fee or $50 fee, or they don't have to pay anything and they can go get their own. I just caution them against that, because then they have to do tax returns and 990Ts. But obviously, if they're knowledgeable enough, they can do it, or they can go with somebody like you guys to help them get one, and then make sure that they fill it out right. But
you know what it is, Carl? We have found the ones that we're troubleshooting a lot of these issues, and the ones who have decided to fill in their own SS4s, which is the form used to secure the number, there's a lot of complex questions that are asked, and they usually answer them in the wrong way. For example, we had an IRA deem themselves to be a trust, and they were open since 1995, and they got a letter from the IRS asking for tax returns back to 1995.
Mhm.
So,
No,
I mean,
that's where I am. I think maybe we should really, I want to get back to UBIT here because this is what our audience is on, but maybe we do another webinar just on the EINs because you bring up some really good points.
Yeah.
I think it's in order.
Yep.
Yep.
Agreed.
Okay.
Well, I think on the slide that we're looking at now is where we begin to touch on the terms, this UBIT and UDFI, and you can see the definitions there, unrelated business income tax and unrelated debt financed income. We can go forward to the next slide and begin sort of discussing the definitions and how it is that it impacts you. From the perspective of being invested in a business, we don't normally recommend being invested in an operating business within your IRA. Now, not that you cannot do it, but there are tax ramifications. Your IRA is typically to be investing in passive activities, and an operating business. I use the example all the time of a laundromat. I have some clients that have real estate, and for whatever reason they drop a laundromat in the bottom floor of it and it becomes an operating business, and the IRS has put these rules in place in order to prohibit unfair competition with other taxable businesses. So we have to go back and define, I guess, what's a good investment to put inside your IRA. And as I said, not that we say you cannot put an operating business in there, but know that there's going to be a tax ramification if you do.
Hey, Beth, on that subject there, I mean, if you're already at the maximum tax rate, and I don't know about the new Trump tax laws, it just, in 2018, but previous to that, people that were at the 40% tax rate said, I would rather have the money going into my IRA, especially if it's a Roth IRA, than coming over to me, and then I pay whatever money on that it generates every year thereafter. So, I don't see any reason not to put a business into.
You're right. If you're already in the top tax bracket, which based on the new Trump law is at 37% now instead of 39.6, the trust rates are the rates that drive UBIT, and they are at the same top bracket. So your top bracket for UBIT would be 37%. The problem is with trust rates, you reach that high tax bracket quicker. So once you get to a $12,000 profit or taxable income number, you're being taxed at 37%. But as you said, Carl, if you're already there, you might as well house this operating business inside your IRA and be socking money away for your retirement.
Right. All right. I just wanted people to understand that there are times when that is worthwhile.
Absolutely. Absolutely. I think I'm going to jump to the next slide here.
You're gonna okay, go ahead. Tell us a little bit about that. No, I wanted to know if there's some times when there isn't, there's exceptions to UBIT, but follow that up with this because I think this is good.
Oh, sure. I just, and I've sort of already touched on this, where the UBIT was put in place when Congress realized that there was unfair advantage to businesses owned within an IRA. And so they formed this tax strategy in order to put us all on the same playing field. So what was your question now? You were just driving me somewhere.
Exceptions.
Exceptions to UBIT.
Yeah.
Would you like to take that one?
Yeah. Well, remember the policy decision here is that the Congress does not want you to compete with for-profit businesses. It would be unfair for me to have that used car lot and be a nonprofit and not have to pay tax against a car lot that pays tax. So they're aimed at that, but it goes further than that. The problems we have, and we confront that in normal taxation, is, are you a real estate dealer or are you a real estate investor? If you're a real estate dealer, then you shouldn't be get capital gains. If you're a real estate, investor, then you're entitled to cap gains. And the same is true if you're a real estate dealer. Then shouldn't you be subject to UBIT? And the answer is yes. You should be. But where do you draw the line? And it's if that person out there that sells the one property a year as a flip, is he a real estate dealer? One would argue that no, he's not. Because there's law under the code that says that until you sold 5 properties, you're not a dealer. But it's those are the concerns. These aren't bright line tests. I wish it was black and white, but oftentimes it's not. So, but the real clear tests are the ones dealing with businesses. If I'm in that used car lot, then I'm subject to UBIT, and it's something that's going to be taken care of. And there are the exceptions to UBIT. Are basically, one is that the first 1,000 of net income is not subject to UBIT. And again, keep in mind, Congress wanted these plans to invest in passive income. So dividends and interest make sense. Royalties, and that could be subject. What if I'm an inventor that's making toys for Mattel or the former Mattel, and can I get away? Can I have those inventions through my IRA? Probably not. I mean, it's going to be subject. You can, but it's going to be subject to UBIT. But royalties in a passive sense wouldn't be subject to UBIT. Rents, again, the passive rents would not be UBIT. And so these are some of the exceptions to the UBIT rules that you'd have to. And sometimes you're not sure if it's UBIT or not. So these are judgment determinations, and a lot of people we have found don't even realize they're subject to UBIT,
right?
Which is alarming, because then 5 years later, when a fiduciary comes to you and say, I think we should have been filing 990Ts for the last 5 years, and there's substantial penalties involved, and it's really an area that is overlooked, and there's not a lot of IRS intervention at this time.
And I think it's important for the client to realize, if they would just call a professional like Kerr Law or myself and find out the structure of the transaction, and it could be broken into 2 pieces. For example, we have a few examples to follow where an IRA is a 25% partner of an LLC. The LLC owns a building that it rents to Corporation X. The LLC also runs a t-shirt printing shop. The rental income is not subject to UBIT based on the prior slide listing the rental income as an exception. However, the income from the t-shirt printing shop is subject to UBIT, much like the laundromat example that I gave. So if a client is brainstorming an idea by himself, with a partner, it behooves him to call a professional that's well-versed with UBIT, and then we can break that apart and be tax compliant at year 1 rather than finding out on the back end.
Yeah, and I might even suggest in some of these cases that they end up with 2 LLCs. You know what I mean?
Mm-hmm.
Yeah.
One that doesn't, one that does, etc.
And I think this next example is something that where Wayne was talking about dealer versus investor, where the example is IRA is 100% owner of LLC. LLC buys a piece of real estate, renovates it, and then sells it for a profit, the typical flip. One flip isn't likely going to be subject to UBIT. However, if you start multiples, there is a comfort level. There's a line that each professional is willing to jump over. I know we were talking about 5. Once there's multiple flips, the IRS can come in and start to deem you a dealer. And now we're talking about being subject to UBIT again. So each transaction layers upon the next, and we have to, and it, just because you're not subject to UBIT in year 1 does not mean in year 5 that you may not be.
And know what we're finding, Carl, the mentality of the people that we have dealt with, these are the hardship cases have come to us in desperation, that there's just a mindset out there that one is that it's IRA, so therefore it's not taxed. And 2, the accountants aren't really looking into these areas. They're busy preparing the 1040s and really not addressing some of these UBIT issues. And I think there's a lot of UBIT tax out there, and it's that is not being collected.
No, I agree with you, and I think one thing to add here is that the intent, if you have the intent to flip, even if you have one, I think you're going to be subject to UBIT. Going back to my conservative.
In fact, there's a case on that issue, Carl. It's called the Malott case, and the question is, what is the intent? But again, if you clearly demonstrate the intent, that's one thing. But what if you've had a history of buying property and renting it out, and you buy one, and all of a sudden the best deal comes along and you sell it? What was your intent?
Yeah.
So,
well, I mean,
that, careful in that area.
Yeah, no, that does happen to me. I have several properties that I buy and hold because I'm a buy and hold guy. But every once in a while, I end up selling a property, one because they change the zoning in the area, or it's requiring too much work, or the city changes laws about renting to students, etc. So it's no longer viable. But that wasn't a flip anyway, because I'd held it for a couple years.
Yeah.
But sometimes I get into these things where I have got an offer. Back in 2007, there was one that I was going to fix up and rent out, and somebody offered me like $50,000 more 2 weeks after I bought it, and I just kind of said, that seems like a good way to pick this up. So
you know why? And that just demonstrates the importance of having someone like Beth on your team, that you can brainstorm this before you get into it and decide which way do we want to go here.
Absolutely.
So, like you said, if your intent is clear that you're going to flip it, then you're going down the UBIT route. But if it's unclear, but consulting with someone like Beth who understands the various roads, I just think it brings a team member in that adds to the strategy.
Yep, and you can definitely make sure your intent is known. There's Beth can help them figure out ways to document that.
Mm-hmm.
You got it.
Yep.
Okay.
All right. Well, I'm ready to jump us to unrelated debt financed income, unless there's other questions regarding UBIT.
Nope. Let's UDFI, or unrelated debt finance income, is just another area of UBIT, right?
Yes, it is. I find for some reason that this one troubles people a little bit more for some reason, but there's a little bit of a calculation involved. And this basically happens when there's debt involved. And so, for example, if we purchase a rental property and we don't quite have enough of our own assets to get the purchase made, and there's debt involved, now there's a calculation that has to be made that taxes some of the net income from that investment based on a ratio of average acquisition indebtedness versus the adjusted basis of the asset that we hold. So there's a little bit of math involved here, but in the end, if there's debt involved in your transaction, you need to perk up your ears and hire a professional that understands unrelated debt financed income and realizes that there may be a potential for a 990T filing.
Can we do a calculation, Beth?
Sure.
Yeah.
Sure. Go ahead. Let's go right to the next slide. Oops, there we go. Okay.
Yeah.
So 3 concepts needed for this calculation. The net income from the property during the year. So we're assuming at this point, we're talking about a rental property. If the rental property runs a loss, there's no UDFI to be paid on. But if we have a net income figure at the bottom of your Schedule E, or whatever form you have to be filing, Schedule E is this form for the 1040 rentals. We would also file that and come out with our net income figure. Now, we take our average acquisition indebtedness during the tax year, the average adjusted basis during the tax year, and we multiply the net income by that factor of average acquisition indebtedness over adjusted basis. Now, if you jump 2 slides, come with me. I'm going to actually bring real numbers into it. I did want to show our viewers that I have updated these tax rates for the new 2018 tax laws. These are the new trust rates and that the 37% maximum rate is shown there. Let's jump to our example with real numbers. It'll help us put this into action. So our rental property is worth $1 million, and it is purchased by an IRA with $600,000 of funds. Depreciation for the year and capital expenditures are equal, and therefore the yearly average adjusted basis is $1 million. No payments on the principal are made, so average acquisition indebtedness over the course of the year is $600,000. This makes our UDFI factor at 60%. So we've made the math easy so we can follow.
So is that 600 over the million? Is that the way you determine that?
Yes.
Okay. Okay.
Now, if our rental property generated $30,000 in net income, for example, then the taxable UDFI would be $18,000. And
how is that determined, Beth?
That is basically $30,000 multiplied by your 60%.
Okay. Okay. Got it.
The first 1,000 is excluded just from a blanket, almost like an exemption, if you will, on the tax return. So that first 1,000 is excluded and reduces your taxable income then down to 17,000. And then the trust tax rates are applied to that taxable income figure of 17,000. So in this particular example, using the new tax brackets, your tax on 17,000 would be $4,676.50. And that tax is reported on Form 990T and remitted accordingly.
So basically, you've put in 25, a little over 25,000 into your IRA with this example, even after paying the taxes, and the Schedule E took into effect all the depreciation, et cetera, to bring it down to the 30,000.
Mm-hmm.
Okay.
So still a good vehicle, even though there's tax due.
Now, Carl, one of the things is that we talk about all the time is, the IRA versus the 401k. Obviously it's beyond the scope of this presentation, but that's if you're using UDFI, that's one of the reasons you may prefer a solo 401k versus an IRA because of it's not subject to UDFI.
Right. Yeah. 401k is not. You're 100% right there. That's great. Great point to make. The other thing that isn't subject to this is if it was government housing. I don't believe that's subject to UDFI either, whether it's in an IRA or a 401k.
I think you're right because it was. That's what Trump said.
Okay. Mm-hmm. All right. So now we have an example here where we're using the same facts, but I have some interesting points to bring up here. We have our $600,000 in debt to purchase the $1 million property. However, the rental property is now generating a net loss. So there won't be any tax per se. And we even have next on the slide that there cannot be any benefit from losses passed through. And by that we mean current year benefit. You're not going to benefit from, if you had a rental property under 1040, subject to some AGI limitations, you may or may not get a current year benefit from a rental loss. In your SDIRA, we do not have a UDFI or a UBIT filing requirement. However, we have filed in the past 990Ts for individuals in order to start tracking losses. And by that I mean in year 1 through 3, you may have some losses as you're getting tenants in place and things like that. By year 5, you might be running a nice rental income. And now we can start to net prior losses against current gains and save some tax. So there may or may not be a reason to file a 990T even if we're running a loss.
Because we have clients come to us, Beth, and say, we really have even though we pointed out you have UDFI income, we really have no need to file. But, what we've taken the position is that, yes, maybe we should file to just document these losses and the percentage that when we start to generate income, then we'll just offset that income against these prior losses.
And I feel like at one point too, Wayne, correct me if I'm wrong, where we had filed for someone just to start a statute of limitations. There can be other legal strategic reasons to start a filing.
That's right.
So
Yeah.
again, we should consider it on a year-to-year basis.
And a lot of times this is overlooked and a recommendation not to do that, but we've done this in the past.
Yeah, no, I mean, just think about that person that you said did it back in 95. If they were doing it, or didn't do it in 95, now the IRS can go all the way back to 95. Whereas if they had been doing it every year, they could only go back, what, to 3 years or maybe 6. I've heard that argument before too.
Mm-hmm.
Yeah. Okay. Yeah. Sometimes other considerations is sometimes you'll hear double taxation, that UBIT creates a double taxation, that you're paying it at the IRA level, and then again, you're paying it at the individual level. Really think about it, Carl, and you deal with this all the time, is that if you're paying it out at the IRA level, it's not available for distribution. So is it really being double taxed?
Well, I know in a Roth IRA, it's not for sure.
Yeah, but think about it from a traditional IRA. If I had 5,000 that I paid in, let's say I had 50,000 and 5,000 of it, or let's just use the example of 30,000. I had 30,000 and there was 5,000 in UBIT tax. So therefore I'm ending up with 25. On year 2, when I distribute the 25, only 25 is going to be subject to tax, so therefore, even though you pay tax on it, it's not getting taxed twice, in my opinion.
Right. No, I understand. I see where you're coming. You made the 25 and it's not there, but other people say, hey, you made 30, you had to pay tax, and they compare it to a Schedule E. And
but there'd be double tax if you had to pay tax on 30, not, so you're only paying tax on 25.
Right.
So, but yeah, it's just something that we hear all the time, that, well, it's double tax, and is it really double tax? Because on the way out, you're not getting taxed on the 5 that you used to pay.
Yeah. Nope, I'm with you 100%. But the way I like the Roth IRAs, even if you have to backdoor them now with the income limits.
Yeah.
Mm-hmm.
And Carl, there's been some changes in the conversions and things that you really, obviously another seminar, but in 2018, there's been changes on the recharacterization rules that should be.
Yeah, they've gotten rid of them. But I'm with you 100%. We can do another webinar on that. Let's.
Okay.
Yep.
With you.
Okay.
I want to touch on this next point on this slide. We sort of already touched on it with regards to cities, but when we're talking about Form 990T, typically we're talking on a federal level, but many states impose UBIT, and I think folks forget about that. They think they're safely tucked into a deferred IRA vehicle, and they don't realize that sometimes states and localities want their piece of the pie now. I've listed some examples there of states that I know do address or impose UBIT, and it's nice, though, that the states where we happen to be sitting in do not. So the states that do not, New Jersey, PA, Delaware, a lot of the surrounding states of our businesses, Carl, are safely outside of that. But as you brought up Philadelphia, I know I've had several clients where I found out years later that they owned rental properties, and here they were parked in the city of Philadelphia, and I had to go back and file back BIRT returns, Philadelphia Business Income and Receipts Tax returns for them, because Philadelphia does want their piece now. They have a gross receipts tax and a net income tax, and that is required to be filed. So you want to make sure that not only are we looking at this from a federal level, but from the state and city and local level as well.
Along those lines, Beth, is I actually went to the chairman of policy for Philadelphia on why they're subjecting these LLCs and all to the BIRT, and it's in terms of the IRAs, and they realize it. And I said, I think if there's a case out there, I think if there's a case that justifies litigation, I just think it can be beat at the city level. But at this point in time, they're taking the position that it is subject to tax. So just beware of that, and beware of any locality you're working with as to what their position is.
Okay, our next slide takes us into plan asset rules. And I'm not so sure we want to run through all these details. However, it's up to you, Carl. If we have a little time, we can talk about plan assets from the perspective of how they may be subject to UBIT. There's connection to UBIT as far as an operating company being subject to UBIT, since the definition of an operating company is trade or business, things like that. Do we want to go that deep, or should we save this for another time?
Well, time is kind of, you know, I appreciate your time today, so I'm going to leave that up to you. But if you don't mind, if you went back and you were talking about UBIT in some of these states, does that also include UDFI?
Yes, it would be under the UBIT. I mean, remember, UDFI is a subcategory of UBIT. You know, UDFI becomes UBIT. So I think the answer is yes. We don't deal with it that much, Carl, because a lot of the states we deal in are basically, you know, not subject to it. But
I got you.
But
I was just looking at Florida, and Florida doesn't even have a state income tax, so they must have their own UBIT form or UDFI form, like a 990T, I would assume.
Yeah, I saw that, and I you know, Florida at one point in time had an intangibles, but they've gotten rid. They still have limited intangibles, right?
Yeah.
Yeah. So I don't know if it falls under the intangibles or not, but this is a research source Beth pulled up. I was surprised to see Florida myself. So
all right. Well,
you can clarify that.
Yeah, we can talk about that offline, but I'd like to, let's go back and see. If you have time, Beth, I'd like for you to go through those.
Sure. Yep. All right. Let's go back here. So the purpose of this rule to determine when assets of a company are owned by an IRA. I know we talk here on the slide about operating and non-operating companies, operating companies selling product or service, non-operating companies being passive. As we were discussing previously, passive is what was intended for your IRA to be invested in. However, as we said, it is not discouraged to put an operating company inside the IRA, but within certain sets of rules. On this slide here, we talk about assets of an entity. Assets of an entity and the ownership interest in that entity are treated as assets of the IRA if the entity is owned 25% or more by IRAs. So we have to be careful. If my IRA and Wayne's IRA and your IRA combine to own an LLC, that's owned more than 25% by IRAs, and now we have issues. So now we have to consider that in our transactions, consider that in our tax planning.
One of the confusions we find, Carl, is that some people feel that, for example, if Beth was invested in an IRA at 24%, and I was invested at another 10%, would those plan asset rules apply? And the answer is yes. I mean, but some practitioners look at it as long as Beth's interest is under 25%, then the plan asset rule does not apply. But the plan asset rule goes beyond that. It looks at the LLC and says what percentage is owned by all IRAs in the LLC. So therefore, if there's more than 25% owned, in the example I had, 24 and 10, then it is subject to the plan asset rule. And you're
all right. So let me make it a little simpler for the audience. So if Beth's IRA owned 30% and you personally own 30% and I personally own 40%, the plan asset rules would still be in effect because Beth owned 30%, right?
That's right.
In her IRA.
That's right. So
okay.
Therefore, that would be an excellent example. So, but if what this example I was trying to demonstrate is that if Beth was owned 24% and let's say the rest was owned by non-IRAs, then there wouldn't be a plan asset rule in effect.
Gotcha. But if one of those IRAs had 1% or more, then it would.
Yes, that's correct.
All right. So let's talk about that and the next one and what happens as a result of that.
Okay, now one last caveat is that if you're non-operating, it's 25. If you're an operating company, would have to be owned 100%. So therefore, that's a whole different scenario. So that's okay. Go ahead, Beth.
Yep. So I guess where we're going with this, I kind of feel like we're leading down the road of prohibited transactions too, which is another aspect of this. But
right.
But being that we're and we have some nice examples, which I think will help simplify it on the next two slides here. So maybe we just jump there. But in connection with UBIT, the operating company is going to be subject to UBIT since the definition, since by definition it is an operating company. Where if we're in a passive situation, as Wayne said, the percentages change from 25% passive to 100% when you're in an operating company. So I want to be careful to point out that operating, and then let me slip over to.
I think what Beth is saying, Carl, is that in an operating company, remember, you still have passive income, or you still have operating income, I should say, and therefore that would be subject to UBIT. From a prohibited transaction standpoint, then you would be testing it for prohibited transaction because if you're under 100%, it's not considered plan assets. But let's go on to the next example.
This example's good. So then, this is our non-operating slide that explains the prohibited transaction in one plan and a disqualified person. You're basically, once you're talking about prohibited, you've made your plan a plan asset. Okay.
Let's just run through that example.
Okay. So this example, I think, will clarify it like you were trying to do, Carl, with our simple example. Golden Egg LLC is owned 15% by Steve's IRA, 10% by Paul's IRA, and 75% by other non-IRA members. Paul and Steve are unrelated. Golden Egg buys real estate and collects rental income. It is a non-operating company because real estate being a passive activity. Since Golden Egg LLC is owned 25%, which is the combination of Steve and Paul's IRAs, since it is owned 25% by IRAs, then it is considered the plan with respect to Paul and Steve. Therefore, even though Paul owns 10%, anyone who is disqualified with respect to Paul, such as his mother, such as his son, and his plan, is disqualified with respect to Golden Egg. So those tests now slip into the combination of what's disqualified for Paul and therefore becomes disqualified for Golden Egg because of the percentages of ownership. Does that help our viewers? Does that beg any question?
I don't know. It's a little bit confusing, but I think I see where you're going with it.
Well, the end of the day is that, you have UBIT out there and you have UDFI issues. And quite frankly, the straight analysis, you can do it, but you can have situations where you don't think you have UBIT, and because of the plan asset rule, may actually throw you into a UBIT situation.
So if you're partnering up with someone else, you have to be careful who it is you're partnering with and whether their assets they're bringing into the LLC are IRA assets or otherwise.
Yeah, I just, just to make this easy, I look at it, I kind of understand it, but I give it to, someone like you, Beth, and say, what's the ramifications, what's the tax ramifications of this? And then I see whether the deal is worth it or not. And I haven't had a deal yet that isn't worth it as a result, because the UBIT gets played down when you look at all the stuff that's in there, because you're only paying on your 10% as an example. Or your 25% of the total income from it's not that big of a deal. But I guess if you had a lot of, $1 million into it, it could be significant.
Think about it too, Carl, from a lot of the syndicated deals, if you will, really, these don't even come into play because you own such a small percentage interest of a total that you're not even dealing with that in terms of the plan asset rule. But at the same time, if in fact it's activity is passing through, then you certainly have that impact too. So I mean, there's a lot of different issues on these UBIT that really are not being addressed. And like I said, on the syndicated ones, they really should be indicating whether or not it's unrelated business income tax. And I know the major players are, and some of the, I think the one situation you're saying is the person is being paid guaranteed payments. Are they in fact UBIT? I don't know. I mean, to me, I would think that is a UBIT.
Well, the other point that you bring up here is, what if I have, what if there's 50 people in there with 1%, between 0.5% and 1% ownership, but so now they're at 50%, and based on the 25% rule, it looks like the plan asset rule would come into effect, even though there's 50 people with 1%.
That's right. Depending on the nature of the, depends on the nature of the entity. If it was non-operating, if it's real estate,
that's right,
non-operating.
Because this next example, which is our last slide, takes it to the next level, which we're really more talking here about who's disqualified and what's prohibited, as opposed to the UBIT impact of it. But in this example, same scenario of who owns Golden Egg, where we know that that is a plan asset, but this now this LLC wants to lease the building to a corporation that is owned 58% by one of Golden Egg LLC's relatives. That's a problem, and so we have to. That's why we say each transaction needs to be identified and strategized before you execute on it, because now Steve's father has become a disqualified person because of the amount of IRA ownership of this LLC.
But,
yeah. Well, that's a problem even without the UBIT, right?
That's right.
Yeah. And that's where I see a lot of the usefulness of the plan asset rule, is that I see it. I'm more concerned with it in the prohibited transaction area than any.
Gotcha.
So I just that was the summation of the presentation, and I feel like we kind of veered off of the UBIT a little bit, but I feel like each of those factors plays into the discussion of UBIT in the end. And moral of the story is, you need to find an accountant who's familiar with UBIT, that's not afraid to tackle it, and is able to handle the filings for you as needed.
Yeah, the other thing too, Beth, that I figure out is, I mean, I can do drywall and I can do forming and things like that, but there's people out there that are better at doing stuff, and I could probably bring the books out and figure this out myself, but I do what I do best, and try to find people that do this stuff better than me. So that's another reason to get a good accountant and attorney on your team, so that you can spend your time either buying another property or doing another deal, whatever your expertise is. I think that helps you make more money, and you can just tell me, if I do it this way, it costs you here, because everything has a pro and a con, I've found. So those that are just listening to this, I want to make sure that they have your telephone number and your email and your website. Could you say that so that they can call us if they can't see the slide that you have up?
Absolutely. We have offices in Philadelphia and also in Marlton, New Jersey. Our Philadelphia number rings everywhere, so you don't have to worry about where we are that day. Our number is 215-772-1200. If you want to reach Wayne Kerr, his email is Wayne Kerr, WAYNEKERR @WPKerr.com. My email is bcummings, CUMMINGS @WPKerr.com. And we're just about to launch a new website at kerrandcummingspc.com. The and is spelled out, by the way, it's not an ampersand. So we're just about to launch our new website. It's not quite up and running yet, but we'll be excited for you to see it once it's out there.
All right, I really appreciate the time, Beth, and you too, Wayne. Thanks for coming today. And if people have any further questions, I know we're running out of time here. I would like for them just to contact you through your website. www.kerrandcummingspc.com, KerrandCummingspc.com. Anything else you want to add, Wayne or Beth, before we stop the recording?
No, but we want to thank you so much for having us. And obviously, any questions anyone has that come your way, you can feel free to send them to us, and we'll be glad to address them for your clients.
Okay, I know in the past that you've offered a 15-minute consultation to people that listen to our webinar.
In fact, I'm glad you brought that up. I wanted to offer my services as well. I know Wayne has offered his services in regards to formation of LLC. I am also available for consultation on investments. For 15 minutes, I'll be glad to entertain a structure or an investment that you're thinking about, or help you walk through filings of 990Ts or questions you may have on past filings. So please, if you've listened to this webinar, we thank you, and we're glad to offer 15 minutes of free consult time.
Okay, so any of the audience that wants some of this free advice, please just mention CamaPlan webinar with Beth and Wayne, and they'll take care of you. Again, thank you very much, Wayne and Beth, and I look forward to seeing you in the near future.
Thanks for having us,
Thank
Carl.
you, Carl.
You're welcome.